Okay, Anita, today we are going to take a review of the changes in KYC directions by the 28th April circular of the RBI. So I think to begin with, if you can give a very quick overview of what is the essential thrust of the changes, what all are the perspectives of the regulator in making the changes, why do they come, and what are the areas where the regulations have been changed. So let's maybe start with that.
So first of all, it will be important to note that this is 2 years long, after which there has been a change in the KYC directions. The last amendment in the KYC directions applicable on banks and financial institutions, NBFCs, was in 2021. And now this year, we have amendments in the KYC directions. This year, if we recall in the budget, also it was proposed by the finance minister that there is a need to encourage financial sector regulators to have a KYC system which is fully capable of recognizing the needs of digital India. So emphasis was laid on making KYC more friendlier for digital fintech lenders, digital lenders. Now, the changes that have come by this amendment, there are 4 things that it has brought about, or you can say it is a result of 4 things. First is the changes in the PMLA rules, basically, that was there in March, 7th March. There was a notification. There were a couple of changes in the PMLA rules that has been incorporated in the KYC directions. These include amending the definition of group, bringing group companies also under the purview. Now, what will be the changes? Maybe we can discuss later on, but effectively it is the PMLA rules, the changes there that were made over there that has been implemented or captured in the KYC master directions as well. Second, non-face-to-face lending, that is the, you can say the buzzword or the talk of the town right now, which is seeing its rise over here. To align the KYC process with this increase in the use of non-face-to-face lending, the transactions that are happening, that is one of the attempts that the regulator has made to maybe have lay down the process of carrying out this kind of a KYC process for non-face-to-face lending transactions, and what will be the enhanced monitoring that is required to be ensured by the financial entities before undertaking such transactions. Also, there has been certain instructions based on the implementation of Section 12K of the Weapons of Mass Destruction and the Delivery Systems Act 2005. So that is again one of the changes in the regulations and the KYC directions, and certain other instructions have been updated based on the FATF recommendation. Some more you can say compliance requirements on the part of the regulated entities. So this will be the gist.
If you were to, for a minute, take the weapons of mass destruction as, let's say, a little extreme item, none of, the borrowers that we probably might be concerned with might be even distantly connected with something as serious as that. And therefore, if you were to focus on 2 things, you mentioned faceless lending, non-face-to-face lending, and therefore enabling KYC in that process. That's part 1. Part 2 mentioned the changes which were introduced in PMLA rules, which are now reflected in the KYC master directions. And you mentioned about number 1, the definition of group. Number 2, maybe the lowering of the threshold of beneficial interest, which we come back and discuss later. So with these changes, Anita, what are the various modes in which financial entities may now do a customer due diligence or a KYC process? What is the, summary of the various modes through which KYC may be done right now?
Okay, so maybe let us discuss the existing modes of KYC first. At present, the various modes of KYC that we know, traditionally, we were doing physical KYC, wherein the representative of the RE or the lender would go and visit the customer, verify the documents originally seen and verified was being done for the KYC documents that the customer was submitting. And it was a physical mode of KYC. Either the customer would visit the bank branch or the lender's place of office, or the agent or the authorized representative would go and meet the customer. This was pure traditional mode of physical KYC that was being done, and that is still being done by some of the lenders. Second, there was a change initially that RBI had brought in this concept of digital KYC. Now, the term that RBI had used was digital, but if you see the process of digital KYC, it was actually just the mode of capturing the documents, or you may say mode of storing those documents and information that the customer has provided in a digitized manner. It was not the process that was digital, because there was still a physical intervention that was required, because either the customer would come and visit the branch or the agent would go and meet the customer. Only instead of taking physical copies or having those papers being carried, it was an app that was specifically designed for carrying out this entire process of digital KYC, wherein I would capture the photos of the KYC documents of the customer and do the KYC process. That was digital KYC. Recently, then VCIP, or video customer identification process, was also introduced. Now, VCIP was considered to be at par with face-to-face KYC process. So it was as good as meeting the customer on a face-to-face basis, because under a VCIP process, the person sitting at his home would interact with the authorized representative of the lender and submit all the documents, provide all the information, interact with the authorized representative, and that is how the KYC process was being done. There was another mode of KYC, which was OTP-based eKYC. Now, this was Aadhaar OTP-based eKYC, and it was only banks and certain authorized NBFCs which were able to carry out this process, because it was only based on authorization that you could have access to the Aadhaar number of the customer and carry out this kind of a OTP-based eKYC. Again, this process was also restricted, because over here it was not applicable for any kind of lending or any kind of account opening that I could follow this process. It was only valid for 1 year. Also, only small ticket size loans up to, say, for loan transaction, the limit was 60,000 only. So only for those kind of transactions, I was allowed to carry out OTP-based eKYC. Now, with the amendments that we have, there is a non-face-to-face mode of KYC that seems to be introduced, wherein the documents can be obtained from the CKYCR or Digilocker of the customer. He can provide me access, and I can have enhanced due diligence or enhanced monitoring in place to have to allow the customer onboarding, and then the transaction or the lending process can be initiated.
So you're now talking about in sum, you're talking about 5 processes now. Physical KYC, which is based on physical interaction with the customer. Then we're talking about digital KYC, which is still based on physical interaction, though the documents are captured in digital format. It's still based on, it's an interactive and physical interactive process. You then talked about a VCIP process, where the entire thing happens to a video interaction. People don't need to meet physically, but there is still a video participation of the customer in a process. I guess the process will include capturing the images of the documents, and then maybe doing some kind of video imaging of the customer to prove his face recognition, or to capture his face recognition as well. OTP-based eKYC, which you said, number one, has several limitations. Number one, it's limited in terms of time. Number two, it's limited in terms of amount. All the more, it's limited in terms of number of entities or authorized entities which may carry this process. These were the 4 originally. The 5th one now talking about a faceless or non-face-to-face KYC, where you can capture the documents from a particular storage, which could be CKYC or maybe Digilocker. Download the documents from there. You got the documents. Now, what additionality do you need for the so-called faceless? You download the documents. What else? Is that all, or is there anything beyond that?
So, enhanced DD measures have to be put in place in case I'm downloading the documents from Digilocker or I'm having access to it through the CKYCR portal. In that case, the enhanced DD measures, there are 5 DD measures that have been prescribed, 5 or 6, I think. First, if it is a VCIP enabled entity, if someone who can, an entity and a lender who can carry out VCIP, who has that infrastructure to carry out VCIP and carry out the customer due diligence through VCIP, then that has to be conducted.
Then I don't need the 5th one. I already have the 4th one, which is VCIP.
Right.
Then I don't need. So that's actually a surpluses.
Yeah,
if I don't have VCIP, because if I have VCIP, I'm not talking about the 5th one anyway.
Right.
If I don't have it, then what are the additional so-called enhanced due diligences?
In case you don't have VCIP, in that case, first of all, you have to ensure that you have to take the PAN of the customer. Now, this is very simple. In any loan transaction, in any account opening, even today, PAN was a mandatory document. So PAN needs to be obtained from the customer. Another small requirement is that there should not be any alternative mobile number linked to the account of the customer, because the original mobile number that was given at the time of opening the account, only that should be the mobile number with which I'm interacting with the customer for sending the transaction OTP or transaction updates or anything. For all communication, that will be the sole mode of communication that I'm doing. If there's any change for that also, there needs to be a process that needs to be followed for updating that mobile number. So this again is a simple requirement. Now, third, these type of accounts will be classified as a high risk customer. So the classification of customer based on the KYC that I do is into 3 parts: high, medium, and low. These, because our non-face-to-face customers, would straight away fall in the high risk category. What will be the implication of classifying them as high risk? I will be required to do the periodic updation of KYC every 2 years. So there is enhanced monitoring on the account at any point, at all times, at any point of time. And apart from that, also the periodic updation of KYC will be applicable for every 2 years. Now, these are the 3 requirements which you can say there is no concern, or it is very easy to maybe manage them as well. The other 2 requirements where there are some concerns from the lender perspective. The first one would be verifying the current address through positive confirmation. Now, the RBI says that you need to verify the current address proof that you have taken. You need to verify it through positive confirmation before you allow any operations in that account. Now, operations in a lending account starts from the disbursement itself. So it is not that after I sanction, there is a time gap, especially in case of digital loans. After I sanction, there is a time gap of maybe 10 days or 12 days. And thereafter there is disbursement. And then the customer waits for the current account confirmation or verification, positive confirmation, to be able to utilize the proceeds. So this, in case of even a normal loan account, may not be feasible or practicable, because there is no such operation of the account. Had it been a deposit account or a savings or a current account with a bank, this is still something that is doable. The operations can still be monitored and restricted unless the positive confirmation is done. But in case of digital loans, this kind of a restriction on the operations may not be possible, because the time gap between sanction and disbursement, or the time gap between disbursement and utilization of fund, is very minuscule. I cannot actually have any distinction or any differentiation over there, and I cannot be implementing any physical mode of carrying out positive confirmation. So one view that could be taken is that this verification, because it requires you to do the verification of your current address. So this can be done on a remote basis, maybe through tracking of IP address, or getting the geolocation of the customer from where he's interacting with you, or submitting all the KYC documents to you. And that can be matched with the address proof that the customer has submitted. So if that is being done, if it is within a radius of 3 kilometers or 5 kilometers or whatever seems reasonable, in that case, the positive confirmation of the address proof can be said to be done. This is one way which I think can be implemented for ensuring compliance with the enhanced due diligence measure. Now, another point that is required, or another out of 4 things we have discussed, the 5th one is that the first transaction in such account, which is opened through non-face-to-face KYC, should be a credit from an existing KYC compliant bank account of the customer. Now, yet again, if it was a deposit account or a current or savings account, it could be that the first transaction happens is a credit from the existing KYC compliant account of the customer. But over here, in case of a loan transaction, the transaction already starts from disbursement of funds itself, and thereafter it is in the hands of the customer. It can utilize the funds for the end use for which the funds have been granted. So I don't have any restriction, or I don't have any credit coming from his KYC compliant bank account. Okay, one view over here also that one can take possibly is that the customer may be asked to do a penny drop kind of a 1 rupee kind of a check in from its existing KYC compliant bank account to the lender before the loan is being disbursed. So that will also ensure the lender that which is the loan account in which the funds have to be disbursed, and the fact that the first transaction happened from a KYC compliant account of the customer also gets satisfied.
Anita, I must say, for the benefit of all the participants who are joining us live, is that they can post question on the chat window, and subject to Anita's concurrence, she would probably be able to answer the questions while we are completing this chat as well. Mention about 5 things for the so-called enhanced DD mechanism
Sure. Yes, we do
for
that.
faceless KYC. Number 1, there must be a PAN number. There must be a registered mobile, single registered mobile number instead of 2. Therefore, RMN has to be 1 through which transaction will be done. Number 3, mentioned the accounts will be classified as high risk. High risk means high KYC risk. High risk doesn't mean high credit risk. So you're not saying that this book has now become bad because it's a high risk customer book. The KYC risk becomes high because we have not carried out a physical contact with the customer at all. And then, then you said there must be some positive confirmation, potentially technological confirmation of the address. And because you're simply downloading the document from a Digilocker, there may be question of identity fraud. You've never been in contact with the customer at all. So through your lending process, I mean, create some possibility of doing an address confirmation so that you are ensuring that the address the customer is putting as his current address is also cross-verified. And lastly, you mentioned there must be some credit from a KYC compliant account so that the customer already has a KYC compliant bank account, which I don't think would be difficult. So I think the only hesitation we perhaps have is a technological intervention for verifying the address of the customer, which I am also hoping that most of the digital lenders might probably have technologies that might enable them to carry it out. So you are basically saying with all these 5 enhanced DD procedures, it would be possible to fulfill the dream of the finance minister to make lending fully digital, and therefore not depend on a face-to-face KYC, whereas the lending itself is faceless. I mean, it seems counterintuitive that the entire lending process is faceless, but for DD, I'm still meeting the customer face-to-face. So maybe that that anomaly seems to be now getting finally resolved. Coming to the changes which were done pursuant to PMLA rules, and you mentioned about some changes for example, lowering the thresholds of the beneficial ownership. Now, where all will this lowering of threshold be relevant? When does it become applicable? What will be the implications of this change? Can you maybe briefly elaborate on that?
So the concept of beneficial owner for the purpose of KYC is important to ensure that while I'm giving out loan to any any corporate entity, in that case, to any trust, to any partnership, in that case, I'm not just carrying out the KYC of that entity, but also the beneficial owners of the entity, of that customer. So if the company is my customer, the KYC of that company, of that particular company, along with the KYC of the beneficial owners will also have to done. Now, earlier, the threshold for determining beneficial ownership for company was 25. For trust, it was 15%. That has been reduced and brought down to 10%. So right now, the beneficial ownership depends if you have any controlling interest in a company, which is more than 10%. Now, why is it relevant? Because for carrying out the KYC, I'll have to ensure that I'm also carrying out the KYC of the beneficial owner over here. The determination, since there has been a reduction in the threshold for determining beneficial owner. So you can say the area of coverage, or you can say the number of people who will be regarded as beneficial owner, that can increase, because earlier if it was 25%, I needed at least 25% of controlling stake to be able to be regarded as a beneficial owner. Now it has reduced to 10%. So I think more beneficial owners will come under the purview of being classified as more people will be classified as beneficial owner.
What does beneficial? Oh, sorry, go ahead.
Yeah. So like I mentioned, the concept of beneficial owner is someone who has controlling stake, controlling ownership interest, in terms of entitlement to more than 10% of shares or capital or profit in the company. The person will be said to be a beneficial owner. So you
Not
will,
controlling, we're talking about only 10%. 10% cannot be controlling interest. So we're talking
it
about
is
10% stake, either in the equity shares or in the voting rights or in the profits of the entity. And
right.
we're not necessarily limiting it to companies, all forms of entities, be it a trust, be it a partnership firm, be it an HUF, be it a company, either form of artificial entity. We will be identifying the beneficial owners who have 10% or more stake and carrying out their KYC as well. My question was, what exactly do you mean by beneficial owner? Are you referring to direct as well as indirect beneficial ownership, or referring to direct ownership only?
So beneficial ownership and beneficial ownership under the KYC directions refers to both direct as well as indirect, because even if you have control over that entity through not just direct means would mean that having share capital rights more than 10% or enjoying profits more than 10%. But if I have the right to appoint majority of directors or control the management or the policy decisions of the entity, in that case also I'll be considered as a beneficial owner of that entity.
Not just that, I mean, the beneficial owners may be sitting through layers of entities, a series
Yes.
of entities. Idea basically is to identify those natural persons who are sitting at the ultimate spectrum. I mean, how many layers are in between the natural persons and the entity in question doesn't matter. As long as there are natural persons who are holding 10% or more stake through a network of entities, they're controlling 10% or more of the stake in the entity, then those BOs will still have to be identified and the KYC will have to be carried out for those BOs as well, which actually means more beneficial owners, because earlier threshold was 25%. Companies Act anyway was using 10% stake, but Companies Act is different concept because they are direct owners of shares are disregarded as beneficial owners. Now, does that mean from let's say from current date onwards for all existing loans as well, you will start identifying additional beneficial owners, or will it be applicable only on new loans given by the entity?
So the applicability will definitely be for new loans that I'm disbursing after the PMLA change was introduced. That was in March. So the time taken for maybe implementing these changes, post that all new transactions that I'm doing will recognize 10% as the limit for determining beneficial owners of the entity. For existing loans, if I'm doing any periodic updation of that particular loan account, at that point of time, I'll have to again assess whether the identification of beneficial owner is sufficient to be covered, to be compliant with the revised requirement, or if there is a need to maybe ensure taking or updating the records of the beneficial owner, then that will have to be taken care at the time of periodic updation.
Tanita, you must be happy to note that there are several questions coming on the chat window as well, which means people are receiving this lecture so very seriously. So I have a couple of questions by a person identifying himself or herself as thinker and doer. And that's very interesting, because to be a thinker and doer at the same time is quite a rare thing. One either thinks or one does. Those who do not think, those who think do not do. But here is a person who is both thinker and doer, who says all the measures provided under enhanced DD, are they mandatory? Short answer maybe yes. Is it? Would you like to say yes?
Yes.
They are mandatory.
It is not an optional kind of a thing. All of them are mandatory.
The next question, also by the same person who is a thinker and doer, is what is the meaning of the term legacy accounts in time-bound manner for beneficial declaration and CDD measures for non-individual cases? I'm just trying to understand if I understand the question. What's the meaning of the term legacy accounts in time-bound manner for beneficial declaration and CDD measures for non-individual cases? Legacy accounts means those which already are existing, right? Legacy meaning those which are existing as on date. That's what it means, right? And there must be a time-bound manner, meaning within due time, you must carry the CDD measures for non-individual cases in legacy accounts as well. Is my understanding correct? Did you say?
I'm sorry, maybe I also could not understand the question correctly. What
The question is,
exactly?
there has to be some time-bound manner for legacy accounts for carrying out customer DD in case of non-individual, which means, let's say, artificial entities. There has to be time-bound manner. So I'm guessing that the query is referring to the provisions regarding the lowering of beneficial threshold, saying in case of legacy accounts, meaning those which are existing as of now, you need to implement the change in a time-bound manner, which you mentioned. If you're giving a fresh loan, then you need to do it today. If there's an existing loan, then maybe at the time of re-KYC, or maybe have a time-bound manner to ensure that we do it for fresh, existing loans as well. There's a question from Aditya Srinivasan. Is there any limitation on loan amount for non-face-to-face KYC? There is no limitation. It's applicable to all.
Yeah. Unlike Aadhaar OTP-based eKYC, which is also a non-face-to-face mode of KYC, there is a restriction. But in this particular mode, since there are enhanced due diligence measures provided, so there is no such restriction on the loan amount.
Okay. The next question is from a lady called Kanak Prabha Jethani. Right, this querist, who I think you seem to be smiling, you seem to be knowing her. She says, is positive confirmation for address required in all cases or only where the current address does not match the address contained in the OVD? Is it required in all cases or only in cases where the current address is not matching?
So I think the query comes from the fact that the usage of term that the RBI has done is current address. But again, we need to understand that KYC requirement, when the RBI says that you need to submit the proof of identity and proof of address, it was always meant to be the current address of the individual, or maybe the operational address of the individual or the customer who is applying for the loan. So the distinction saying that since the term that has been used is current address, and only if there is a change in the permanent address and the current address, only in that case the positive confirmation will be done. It will actually frustrate the intent of the regulator for enhanced due diligence. Enhanced due diligence means because I'm not being able to meet the customer. So for me, it should not matter whether the permanent and current address is different or it is the same. Even in case it was different, I was supposed to take within 6 months of onboarding the customer the current address proof. So not doing the positive confirmation in cases when it is the same is not making any relevance for me, because it is a non-face-to-face customer. I don't know the customer. So I should be doing a positive confirmation irrespective of the permanent address and the current address being the same or being different.
To my mind, the reason for requiring this enhanced DD measure is to ensure that there are no identity frauds, such that the person who is filling and filing the application for the loan and the address as per the KYC documents, the address of the person actually filling the application versus the address shown on documents are not mismatched. The idea basically is that it's not that someone else is stolen the identity and with a fake identity, the person is using documents of someone else. Probably that's the intent. So to my mind, I think it should be applicable to all cases, not just where the OVD address and the current address differ. Question from Mr. Venkatgiri Vasudevan, BO for partnerships remains at 15%. Is that so?
Yes, only for company and trust, it has been reduced to 10%. For partnership, it continues to be 15%.
Okay. Next question from Mr. Gora Maheshwari. Would KYC conducted through XML offline verification fall under non-face-to-face mode? Question mark. Even if the employees meet the time of taking the XML file or after some time during physical visit?
So I think KYC process needs to be done before I am disbursing the loan, or it is done at the inception. So if I say that the physical visit is being done afterwards, or maybe after some time, then it is not a complete KYC at the inception itself. So the first question, which was that if KYC is conducted through XML offline verification, will it fall under non-face-to-face mode? The answer is yes, because I can the documents that I can download from Digilocker or from CKYCR includes these files as well. From Digilocker, I can download the XML file, XML Aadhaar file, and verify the identity. So that will be a non-face-to-face mode. But then at that point of time, I cannot say that I'm meeting the customer during some physical visit after some time, and then the KYC process is being completed. So the time lag between downloading that document and meeting the customer, since that could be much more, and it is beyond the disbursement, after the disbursement of the loan that the physical visit happens. So the KYC process has to be complete at the inception itself.
And I have the last question as of now is from somebody identifying as KB. In case of non-face-to-face KYC process, say from a Digilocker, do we need to conduct identification of the customer via VCIP or any face-to-face mode? I'm just trying to maybe rephrase the question. If the query is saying that I already have VCIP mechanism, in that case, VCIP is the process to be followed, because non-face-to-face also says that if you have VCIP, you must follow that mandatorily, right? You agree with this?
Yes.
And or do I need to conduct identification of customer through a face-to-face mode in case I'm doing non-face-to-face KYC? Did you get the question?
Video CIP is considered at par with face-to-face mode. So if I'm doing video CIP, video KYC, that is considered as face-to-face mode of KYC itself at par with.
In which case, the enhanced DD thing does not come into picture at all. Right. And but if I'm doing face-to-face lending, then the question of requiring to conduct a face-to-face identification of a customer, I think that would be counterintuitive. All that you require to do is the current address verification, right? Next question, which is some fintechs do liveliness stroke selfie check, where they take picture of the user and compare with KYC stroke Aadhaar KYC image. Will that be considered as face-to-face KYC?
No, I think this is a part of the VCIP process itself. If you see the VCIP process, one of the aspects is to do a liveliness check or do a selfie check, take picture of the user. So
are you therefore saying that these fintechs should actually be using the VCIP mechanism?
As per the regulations, as per the infrastructure requirements that has been prescribed by the regulator.
Which is though faceless, but it's regarded as face-to-face.
Face-to-face, yes.
Right. Okay. So those are all the questions. And I think with this, we can thank all our participants who joined us live. And thank you, Anita, for providing your gyan on this ever-changing scenario. Thank you very much. Thanks, everyone.
Thank you. Thank you.